Hello everyone and welcome to BFW 2401. This is explanatory video for pre-class activity number 3. Pre-class activity number 3 deals with the materials of week 6, which is liability and liquidity management. One of the most important thing and risk that a bank can have if he doesn't have a very good liquidity management is a bank run. Now, bank run have been seen during the financial crisis. It has been seen here before the financial crisis in Malaysia. We see it in Burma. We see it in Bank of Victoria in Australia. And bank run happens when all or most of the depositors run to the bank, which means go and withdraw their deposits, either through their devices online or going to the physical bank and queue. Now that is happening, and not because they need the money, but out of fear. Fear of what? Fear that the bank may be insolvent, and therefore they want to withdraw their money. The reason is actually the contract of the saving accounts and current accounts and all those type of accounts. When there is a bank run, bank will serve the first comers. So first comers, first serves. So if there is, they will start to distribute the cash for the people who are queuing and want to withdraw their deposits. But then if you are in the queue and you receive your deposit full 100% and the money is finished, then the next person in the queue will receive 0. And this is why if there is a bank run, everybody will run first to reach the bank before the other person and to queue so they can receive their money. Now, regulators have realized this, especially after the financial crisis and also before the financial crisis, and it introduced something called deposit insurance scheme. Now, in this country, we have something called PIDM, which is an insurance agent that pays up to 250%, 250,000 ringgits if there is a bank run. And also we have in Australia FDIC. Now, FDIC is also another insurance a party to insure depositors if there is a bank run. They will pay you, or the bank collapse, they will pay you up to 250,000. Now, the problem is if the management and the shareholders interest in taking more risk, that will give them, their interest is to take more risk in loans or businesses that will give them more return, then in this case, they may, because they know that they are insured, then in this case, they may tend to increase the risk, which means we are now to a problem called moral hazard. A moral hazard is when the insurance scheme is not used for what was supposed to be, which means it was for this deposit insurance scheme was supposed to decrease the bank risk, actually the liquidity risk. But now, if there is a moral hazard, actually it leads to more risk. This debate has been here and there for a long time, and regulators try to understand it. And this week, I brought you 2 cases to introduce first what is a bank run. We have seen it in so many places, but one of the most famous one was I brought an very old case in 1930 after the Great Depression for a bank called the Bank of the United States. Also I also brought another case after the financial crisis, which is for the Northern Rock Bank in the UK. We have 5 questions. Please try to answer the first 4 questions are multiple choice questions, and the 5th question, which is your input in this issue. In that questions, which is the essay question number 5, we have essay question. We have 4 options. One of the options is if you like to write about the current deposit insurance scheme in your country. If you wish to just write about the other options, you can do that, no problem. This is just for international students if they are interested to write about their own country and the deposit insurance scheme. If you want to look at the slides, of course, you can do your own research, but if you want to look at the slides, I think there is something mentioned about insurance deposit, bank run and deposit insurance scheme, and slide number 33 and 34, and also something about the deposit insurance scheme and slide number 64 and 65, previously mentioned, but I want you to do your own research. Write your essay, cite the references, and bring the list of references, and enjoy this process. It's a really very hot issue in banking, which is bank run. If you know bank run, you actually know liquidity, because bank run means, if you don't control it, means bankruptcy, and bankruptcy means bank failing, and that will destroy the bank, shareholders, and the system, and so many things, especially if we are talking about big banks. For that, I want to conclude. I will see you soon in the workshop, and also for the in the tutorial. For this pre-class activity, I give you 2 days. When you open the test, you have 2 days, and also it will be submitted on the 11th of September, which is Sunday, 11:55 p.m. We have also a test coming this Thursday, which is in the 9th, so you can work it on Friday, Saturday, Sunday, or actually it's not really related to the slides. I think the videos and the slides, I mean, it's not related to the tutorials that we are covering this week. You can consult the slides and do some research and do it even before, if you want to do things before. Thank you very much and have a great day. Thank you. Bye-bye.